And now we switch gears from periodic to perpetual inventory, and of course immediately you can see why you need a computer for this. It gets a whole lot more complicated because we end up having 3 sets of 3 columns to deal with when we're tackling our inventory. So the first set of columns is dedicated to handling purchases, the middle set to cost of merchandise / cost of goods sold, and then of course the final set is just saying what's in our inventory at any one point in time. Now, if you go back to the original periodic analysis, you'll notice I gave dates here for all of your acquisitions and sales, and of course implicitly our beginning inventory means January 1st. So I gave you that chronology there so that you could do a perpetual analysis here for all 3, for FIFO, LIFO, and average cost, obviously. So when we're doing a perpetual analysis, again, chronology is everything because it determines like how we're going to do the analysis. So we started out with beginning inventory, 200 units at 92, and then the next thing that happened chronologically, you'll recall here, that was 214. We had 1,000 units at 98, so what we're going to do here, and this is the way you always have to handle it, put your newest acquisitions on the bottom, so you maintain the chronology. In other words, what is your oldest stuff versus what is your newest stuff, the stuff you just acquired. So you always have to do it, otherwise it makes doing the costful analysis impossible, or at best treacherous, I would say. What's the practical application of that number right here? That would be your inventory debit, accounts payable credit. That's how you would utilize that number there. Right now, the next thing that happened chronologically was we had a sale on March 1st of 1,100 units. So where did those 1,100 units come from? Again, that's where you reference your cost flow assumption. First stuff in, first stuff out. So you're going to do what? Whatever's at the top of your inventory here, that's the first stuff out the door because that's your oldest. So that means you know all 200 at 92 are gone, and then you sold 900 of the $98 units. What's the practical application of this? That's $6,600 if you add it up. That would be cost of goods sold debit, inventory credit as the practical application of that. That leaves you 100 units at 98 as a consequence. All right, so again, what's up next chronologically? So we had another purchase on April 2nd. So that's going to be 900 at 103, same as before. Slide those units on the bottom there so you maintain the chronology. So we have 100 at 98 and 900 at 103. So we sell, that's our next thing chronologically. We have a sale of 500 units on May 28th. So where do they come from? What's your oldest stuff? The 100 at 98. What's your next oldest? What really, in this case, what else do you have to choose from, right? Is the 900 at 103. So 400 of those are gone, leaving you 500 at 103. Next up chronologically, we had our final purchase on July 25th. So that's going to be 100 at 106. So put that on the bottom. Again, so we have 500 at 103, 100 at 106 in inventory. So when we get to our last and final sale, last thing we have to analyze here, September 30th, where did those 400 units come from? They came from your $103 layer, and that leaves you 100 at 103 and 100 at 106. And that should sound extremely similar to what you saw before. There it is. Okay, got to put it up when I was setting this up. So again, the periodic analysis, whoops, got to freeze that in place, that would help, is this right here, 100 at 103, 100 at 106. There was your total there, 20,900. And if I go back to our analysis here, we would get 20,900. If I added up all the numbers in this column here, all the costs there, guess what I would get? I would get 198.8. Well, why is that? That's the nature of first in, first out. There's no difference between periodic and perpetual first in, first out. Always get the same numbers 100% of the time. And why is that? I'll do a little bit of cleanup here just so it doesn't look so crazy, just to point out the reasoning behind this, or just the fact of it, really. And that is that no matter when you do the analysis, for the whole period or incrementally like we're doing now, your oldest stuff is always what? Beginning inventory. Doesn't matter. You do a periodic analysis, what's the first stuff you is sold? Beginning inventory. We're doing a perpetual analysis, what's the stuff that was assumed to be first sold? Beginning inventory. So because of that dynamic, you will always get the same answer 100% of the time. I cannot devise an example that would give you a different answer. So as a consequence of that, the rule is this. This is for testing purposes. Again, you'll be taking a test online as it stands right now. So when you're confronted with first in, first out, just do a periodic analysis. You get the correct answer. It doesn't matter if they tell you it's being handled perpetually or it's being handled periodically. Just do periodic and get it right. Because again, which is easier? This that we're looking at here or this right here? I think everyone would agree that the periodic FIFO way simpler. So that's the rule. Let's just always go with the, periodic method. Get the right answer 100% of the time. So it doesn't matter what they're asking for. If it's inventory or cost of goods sold, just do the periodic analysis, and you're going to be pretty happy with yourself in terms of how much time you just saved on the test. Right now, of course, when you switch to last in, first out, well, guess what? You got to do exactly what they told you to do. Because with last in, first out, periodic and perpetual will give you different answers. I mean, that's just the way they work. You're not going to get the same answer. So the setup you'll see here is very similar. They start out both with beginning inventory and that first purchase of 1,000 units at 98. Right? So that's where they are the same. Where they depart now is when we do the actual cost flow analysis. So because again, we have to apply this cost flow assumption. We have a different assumption on our hands now. So now we do the cost flow analysis. It's going to be different because now you're going to say, what's our newest stuff when we sold the 1,100? Where did that come from? Well, that's going to be whatever's on the bottom. That's your newest stuff. So the 1,000 at 98 are gone, and we'll have to assume that 100 of the $92 units are also gone because we have nothing else to choose from, which leaves us 100 units at 92 as a consequence. Now, right there, you'll see there's our departure from our other example. If you look at this one, again, this is what we looked at before in the periodic one. Here, all 200 units at 92 ended up in ending inventory. But when we take the same data and analyze it perpetually, that doesn't happen. 100 of those units at 92 got liquidated. So because of that discrepancy, and it's very easy to rig in examples, very easy to come up with this one, that's why the rule for last in, first out is do exactly what they tell you to, because you will get different answers based upon periodic versus perpetual inventory. Right, to continue the analysis, we're still going to purchase 900 units at 103, so put those on the bottom there. So 100 at 92, 900 at 103. We're still selling 500 units. Again, what's our newest stuff? Whatever's on the bottom, so they all come from there. So that still leaves us our 100 units at 92 and only 400 units at 103. Next up, we're going to buy another 100 units at 106. So we have 100 at 92, 400 at 103, and 100 at 106. Note, this is a pretty straightforward example I came up with, and look at all the layers of inventory that are accumulating. This is another drawback of last in, first out. It just gets too complicated. That's why a lot of companies don't choose it, but if they do choose it, this is what they're up against. Right, so now they're going to sell 400 units. Again, what's your newest stuff? Whatever's on the bottom there. So we have 100 at 106 being sold, and then we have our next 300 units have to come from the 103 pool, so that leaves us 100 at 92. And 100 at 103. So again, different because we have 100 units at 103 being inventoried instead of all 200 at 92. So there's your departure. Again, if you look at the differences here in terms of the total cost here, so we have 19,500 here. If I can sketch that out. Oh, still not doing all that great with the mouse being the thing I'm writing with here. So we got 19,500 there, and we had what? 18,400 here. So again, that $1,100 discrepancy, again, just as reconciliation as I'm looking at. There's the cost difference between the units. 103 minus 92 is $11 a unit times 100 units equals $1,100. That just describes like where did that come from. And lastly, for our perpetual examples, we have the dreaded perpetual average cost. Why is it dreaded? Well, that's because we have a weighted moving average on our hands. So every time we acquire new inventory, we got to recalculate the average. It's not as bad as it sounds. Again, I think I organized it in a way that you should be able to probably pick this up pretty straightforward. So we start with beginning inventory, and then we purchase 1,000 at 98. But again, instead of putting something underneath that, what we do is this. We say, okay, what's our total cost that we have available here? In other words, our cost pool. That's why I look at it. Add those two together, we get 116.4. How many units do we have available? We have 1,200 units. So 1,200 divided into 116.4 gives us $97 a unit. So that's the number we're going to use for the 1,100 units that were sold on March 1st. We're just going to say 1,100 times 97, and 106,700 was the cost of the goods sold in that case. So it's pretty straightforward. But again, not from a computational standpoint. Now we're going to purchase an additional 900 units at 103. So again, our cost pool here is 92,700 plus 9,700 gives us 102.4. How many units do we have? We now have 100 plus 900 is 1,000 units, excuse me. So divide that into that, we get 102.4 per unit. So when we sell 500 units, we're going to use that as our basis per unit. So multiply by 500. So that's going to be 51,200 as our cost of goods sold for that one. That leaves us 500 at 102.4 as well. So it's just basically we're just splitting the cost there in half. We buy an additional 100 units at 106. So we got 10,600 plus 51,200. This is our new cost pool. So we have 500 plus 100 units available. So divide that 600 there into the 61,800, and we get exactly $103 a unit. So we'll use that one as our cost per unit for the 400. So 41,200 in that case, leaving us 200 at 103 or 20,600. So this one, I rest assured, is different from the periodic average cost example. So what's the rule with average cost? Do exactly as they tell you to. No exceptions. And that concludes the perpetual inventory material.